I will show you how to use the money from your rental property to pay off your principal home much faster. This will also make your mortgage more tax efficient without needing any extra money, and it will take less than 20 minutes to explain. Let's go. Hey folks, my name is Patrick Fest. I'm a mortgage agent, level 2 cash flow consultant based in Ontario. Today I want to share a strategy that's more relevant than ever due to volatile interest rate, rising cost of home ownership, which is a major concern for most Canadians. I want to show you how to set up your mortgage so you can save on taxes and hold on to most of your money as you expand your real estate investment. Then I want to show you how to use your tax refund and savings, reduce your mortgage balance, pay less interest rate, and become mortgage free ahead of schedule. Paying off your mortgage will free up expensive payments that could hold you back. This will give you more time to do important things, such as improving your lifestyle, buying more real estate investments, or getting a head start on your financial freedom date. The great thing about this strategy, it doesn't require extra funds. You just need to reorganize your extra cash flow in a more tax efficient way. That could result in efficient tax refund and interest savings. Paying your mortgage with a tax refund helps reduce the long-term interest costs, shorten the time it takes to pay off your mortgage. You could use that savings to invest into other assets and grow your wealth. What is cash damage? It's a term used by Canada Revenue Agency to describe this strategy. It's the process of segregating non-deductible cash flow so that you can accurately and safely claim tax deduction on your mortgage debt. So who's this strategy for? If you're listening and watching this, you're probably like most Canadian homeowners. You have a mortgage and you're paying your principal residence with your after-tax dollars. This leads us to a harsh reality. When you consider the true cost of mortgage over time, it's significant. Most people know that the cost of the mortgage doubles because of interest paid over time. Very few people ever take into account how much earned income it takes to pay it off. So the very first roadblock that most Canadians face is we don't have the cash to just pay a full home. We don't have the resource. We need to borrow the fund to buy a house in the first place from a lender. And because the government doesn't recognize our principal residence as an investment, so we can't write the interest off. We're stuck using debt to finance our personal lives, and we're servicing the interest with after-tax dollars. Basically, the complete opposite of what wealthy Canadians do with their finances. Let's say we put 20% down or 150,000, borrow the rest for 600 grand. The payments on the mortgage we make are after-tax dollars, where we need to earn an additional 30 to 40% of income in order to pay the government first. Although we're eating up a major chunk of our disposable cash, we have made our payments on time and we've even made some progress paying down our mortgage. Today we owe 500,000 and the home is worth $1 million. So we have a net equity of 500,000. Unfortunately, along the way, interest rate moved up. Our payment increased. Life in general got a bit pricier to the point where we had to make some concession in order to maintain our same standard of living. So we've sacrificed a small amount that we were putting some investment aside, saying to ourselves, once we get back on track, we'll get the investment going again. All right. Now let's look at how the wealthy person could afford to pay cash for the house. They put $750,000 down. They just bought the house outright. But instead of leaving the funds in the property as debt equity, they borrowed back the $600,000 and used the fund to purchase 3 more properties in the same price range. Dollar for dollar, the wealthy and the homeowner are essentially paying the same debt on the primary residence. They both borrowed $600,000, with the exception that 100% of the interest of the wealthy person is tax deductible because they borrowed the money to invest. Here's where it gets interesting. For the entire life of the mortgage, the wealthy person will pay 40% less interest. That's over $240,000 in interest savings over 30 years at a rate of 5.45, which gives them an option to buffer the impact of rising rates. Double down on their investment, buy additional assets that get even further ahead, just to improve their lifestyle and because they use their equity to build wealth rather than just leaving it sitting there. Now they have 4 properties worth $1 million and $500,000 of equity each. They have $2 million in total equity, while we only have $500,000. Plus, each of their rental generates income which may have barely cash flowed at first, but the value of these rents appreciated over time, so the wealthy person is pocketing all that extra cash. The most painful part of this entire exercise is the wealthy person is normally further ahead because they actually paid $240,000 less interest than we did on our home because they got all the money back in the form of tax refund over the life of their mortgage. Now I know what you're saying. They started with more. It's not fair. They had enough money to buy a house outright. Well, the average Canadian cannot buy a house outright cash. It's a valid point. It's not really a fair comparison. The point is simply that to illustrate there are different ways to structure our debt. And most of us are leaving money on the table because we haven't structured our finances correctly. And that's not our fault. We're not starting from the same place of understanding. There's nothing you could do about how you started, but you can course correct and point yourself in the right direction. Just because we don't have the same financial advantage as the wealthy doesn't mean that these tools and levers are not available to us. We must be more creative and manage our finances in a different scale. That's where a rental cash damming strategy comes into play because it allows us to structure our finances and take advantage of these benefits gradually over time with the right mortgage structure. We could incrementally access the equity to build wealth, buy more real estate, reduce the tax you pay, improve your cash flow so that you could get more of your hard tax dollars back, reinvest the savings and take a run at inflation. And the beauty of it is to accomplish it by simply paying your regular mortgage payments. The ultimate goal here is to convert your non-taxable debt as fast as you can and convert it to a tax-deductible investment loan so you can claim as much eligible tax refund against the debt. The reason why this works is because the federal government has this rule that if you borrow to invest, the interest of the borrowed funds are tax deductible. Because you borrowed with the intent of generating income, you can deduct the carrying costs of the loan, but keep in mind when you're buying real estate, it has to be a rental. It can't be done for personal use. It doesn't work for second home or vacation properties because you can't rent them out. It definitely works when the property generates income. Now that we have an understanding of how the strategy works, let's dive in further and look into the numbers to give you a sense on how powerful this strategy could be and the benefit that a homeowner might get over the life of their mortgage. Let's consider a typical scenario for a homeowner with a $500,000 mortgage. The primary residence at $800,000. The first point to note is this only works when you have at least 20% equity in your home. The reason for this multi-component structure we need to run the strategy are only available to 80% of the value of the home. You do need to have a bit of equity to get started. And if you're not there yet, don't worry. We've got other strategies we could work on together in the meantime to get you to a point where you could implement more advanced financial techniques like this. Since the home is worth $800,000, the homeowner is technically able to set up a structure with a credit limit of $640,000. That's 80% of 800,000. They owe 500,000 on their mortgage, which leaves them 140 that they can access to use as a down payment to purchase a rental. This gives them the ability to purchase a rental property worth approximately 500,000. They use 125 as a down payment, plus a little buffer of 15,000 for closing costs. Keep in mind you don't need to purchase a rental property if you already own one. You can reorganize the cash flow from your existing portfolio and put the strategy to work right away without buying additional properties. So just to recap for you, we're requiring an income generating asset that will help us build additional wealth for the future. We're going to structure our principal residence so we can use the cash flow from the rental to convert our mortgage into a tax-deductible investment loan. This is going to allow us to reduce our taxes, keep our hard-earned money in our hands, not the government, which help us beat inflation and improve our lifestyle over time. We're going to accomplish all this without any additional cash input beyond your regular mortgage payment. Well, let's now go over how to structure our mortgage loan. Then we'll dive into the numbers for you. For this strategy to work, we'll need to put a new multi-component mortgage on the principal residence with an investment line of credit attached to it. There's a lot of product out there that look like it might work. However, in reality, there's many features that's lacking in order to properly implement this strategy. It's vitally important that the investment line of credit is set up for auto readvance, which means that the principal that gets paid down on the non-deductible mortgage automatically becomes available to draw from the investment line of credit. So the funds are available to be drawn out in a timely manner. If the structure doesn't have a readvanceable feature, it's going to cause friction and there will be implementing issues. It may sound complicated, but don't worry, that's why I come in. I will work closely with you to make sure we have the right structure in place and hold your hand and help you get your cash flow going while you learn to implement the strategy. Now, the ultimate goal here is to pay down your bad debt as fast as humanly possible. And the way we could do that is by applying your rental income as a prepayment towards your mortgage each month. Then we borrow the same amount from the investment line of credit to service the rental property expense. Each month, we convert more and more of your mortgage over to the investment line, which results in increased tax refund that you could use to pay down your mortgage even faster and accelerating your wealth building efforts. So here how it works. You make your regular mortgage payment towards your principal residence. Our payments are set to come out from our regular bank account, same as before, nothing has changed. Then we have the rental property, the little orange house at the top of the screen. Then the monthly rental income on the left, and that's where the money we get from the tenant. And then there's the rental expense over on the right. This could include mortgage, principal, interest, property tax, condo fees, maintenance, and so on. The first thing that happens in a cash flow cycle is the tenant pays the rent. On the first of the month, we get payment. Now, what most Canadians do is they take that money and put it in a bank account, dedicated mainly for rental expenses. And then the expenses are taken care of from the same account. Now, on the first of the month, we get payment. What most Canadians do is they take that payment and put it in a bank account. And what they'll do in turn is take care of the expenses from that same bank account. Now, here's a mistake. We should always keep our rental cash flow and our personal cash flow separated. Because if you continue to do it this way, we will miss a wonderful opportunity to create additional tax efficiency for ourselves. Because there's actually no rule to say that you have to use your rental income to pay rental expenses. None. When we receive the rental income from our tenant, it's ours. We can do whatever we want with it. It'll take a minute to get comfortable with this, but our natural tendency is to take the income and put it towards our expense. But it will make sense when there's a better way to manage your cash flow. What we're going to do is use the rental income to pay the non-deductible mortgage first because we get no tax benefit by carrying that mortgage. So let's get rid of it. The first step is to make a regular mortgage payment towards your principal residence. The other step is to use the rental income and apply that as a lump sum towards the mortgage equal to the value of your rent. The principal of our regular mortgage payment plus the prepayment privileges that goes directly paying down the mortgage balance. It creates an equity that's immediately available to draw down and take care of the rental expense. And that's how we run our landlord business. And that's it. Every single month, we use the rental income to prepay our mortgage and we borrow the funds to cover our rental expenses. That's cash jamming. It's really that straightforward. In this scenario, the homeowner has a $500,000 mortgage on their principal residence. They use the mortgage to buy the house, so they're not getting any tax benefit on it. They're on a 30-year amortization at $545, which means their monthly payment is $2,804. Their marginal tax rate is 40%, which means that for any debt they convert to a tax-deductible investment loan, they'll end up getting 40% back every year at tax time. So if you recall, the rental property was worth $500,000. They put down $125,000 in equity, which means the mortgage is $375,000. And the total annual cost to run the property is over $33,000 annually, or $2,753 per month to be precise. The expense includes $25,000 in mortgage payments, principal interest, $5,400 in condo fees, property tax about $2,400. So in a moment, we're going to explore a few different scenarios for each one. The principal residence, the rental property, and the homeowner's financial profile will remain exactly the same as it was displayed on the screen. Let's start looking at the cash flow cycle again, but this time with all the numbers from the case study. We got the principal residence in the center below. We're making our regular payment of $2,800 per month. The payments come from the same owner's bank account, the one as usual. Up above, we got the rental property. Income on the left, expense on the right. We receive over $33,000 of rental income annually from the bank. That $2,753 from the rent, we could use it to prepay the mortgage and drive down that non-deductible debt to the ground. That equity becomes available in that line of credit, the investment line of credit. You could draw it out and put the $2,753 back into a rental checking account. And from there, you take all the funds to take care of the rental expenses. And that's the cycle every single month. We get our rental income, run it through the primary residence, convert bad debt over to the tax deductible side of the balance sheet, draw the funds in to pay out the rental expense. Here are the financial for the scenario where the homeowner already owns the rental property and does not need to borrow the down payment. The first thing we're going to look at is how long it takes to take the full balance over to the investment line, and that is called the debt conversion years. And depending on how many properties there are, it could take typically anywhere from 6 to 12 years to complete the first phase. In this case, it took them 9 years. This doesn't mean that the mortgage is paid off. It just means that you've reached a point where the debt is completely tax deductible, and we're receiving our annual maximum tax refund. The next thing we look at is the total refund earned during the plan. This assumes that the interest rate remains constant and the marginal tax rate hasn't changed either. In reality, these things can fluctuate, but this gives us a sense of total amount of tax refund we could expect to achieve using this strategy. In this case, the homeowner received over $117,000 in refund over the life of the mortgage. Technically, they could do whatever they want with the refund. They can save the money or spend it. But when we do these projections like this, we assume that the homeowner will use the refund to pay down their mortgage faster. In this example, the net effect of using a tax refund to accelerate the plan is they're able to pay off their mortgage 97 months ahead of schedule, which saves them $272,000 in future mortgage payments. Taking into account we make our mortgage with after-tax dollars, we can calculate the level of income required to make those payments at a 40% marginal tax rate. We would need to earn $453,000 to make 97 payments. That's close to $500,000 of income savings that could go towards more important things and possibly help the homeowner retire many years ahead of schedule. Technically, the homeowner is mortgage-free, 97 payments sooner than he would originally be. In order to provide an apples-to-apples comparison, we assume they continue to make their payments all the way to the end of their original amortization, compared with a rate of return on future savings. The calculator also allows us to play with different growth rate assumption. For this scenario, we're using a 6%, which result in a future value of the investment payment savings of $348,969. We could also calculate the future value of the rental, which is $1.2 million. There's no outstanding liability. The investment of the line of credit and rental mortgage are paid off in full, like I said. And finally, we see the net wealth improvement of 348, which is essentially the future value of the 97 payments at the 6% growth rate. It's worth noting that our calculator allows us to include or exclude rental property, depending on the circumstances. In this scenario, the homeowner already owns the rental property, and we would have benefited from the value appreciation with or without the strategy, which is why we are excluding it from the rental value and the net wealth improvement. Well, this is just a taste of what rental cash lending can do for you and your family. I hope you're excited about how this strategy can completely change the way you look at mortgages and investment. If you have any questions after watching this infomercial, please feel free to use my Calendly link. Contact me for more detail. Thank you for checking out this FMFS info, and I hope you found some value here. Don't forget to follow me on Instagram at Festa Mortgages. I'm Patrick Festa, your cash flow mortgage agent. Bye for now.